Welcome back to the Deep Dive. This is where we cut through the noise, take really complex data that usually just sits in reports, and turn it into knowledge you can actually use.
And today, that mission is, well, it's more critical than ever.
Absolutely. We are taking a deep dive into the North Texas real estate market, and we're not going on feelings or anecdotes. We are using the hard numbers, the latest NetTrist data, current as of December 8th, to really understand what happened in November of 2025.
And what's happening right now is this intense psychological pressure across the entire market. The vibe out there is really that people are just holding their breath.
Holding their breath because of interest rates.
Exactly. You've got these elevated interest rates creating what we call the lock-in effect.
Let's define that, the lock-in effect, because it's not just a mood, right? It's a real structural problem affecting supply.
It is. The lock-in effect is, well, it's this paralysis for current homeowners. Think about it. If you bought a home, or maybe you refinanced, say, between 2020 and 2022, you probably have a mortgage rate in the low threes, maybe even the high twos.
An incredible rate.
An incredible rate. So if you want to move today, you'd have to sell your home and trade that amazing low-cost debt for a new mortgage that could easily be double the interest rate.
And most people just won't do that.
Not unless they absolutely have to. A job relocation, a major life event. Otherwise, you're staying put.
So the best potential inventory, the move-up buyers, they're basically stuck on the sidelines. It's an artificial cap on supply.
Precisely, which makes the market feel tight, even as it's slowing down. It tells you right away that the sheer volume of transactions, that's what's going to suffer the most.
Okay, so let's unpack that. If you cut through all the confusion and just look at the entire North Texas region, what's the big headline? What defines this cooling trend?
The headline is unambiguous. The market is cooling, and the power dynamic has definitely shifted. We see closed sales just plummeting. That's choke demand right there.
Again, prices.
The regional median sales price, which is really the best temperature check we have, is dipping significantly. And maybe most important for anyone thinking of selling, the days on market, or DOM, is climbing. It's climbing steadily toward that 3-month psychological barrier.
Every key metric is moving against sellers.
Every single one.
You said that the regional median sales price dip signals a critical shift. Tell us why. Why is a 5.4% drop, which is what the data shows, why is that more than just noise?
Because the median sales price, the MSP, it tracks the market center of gravity.
Mm-hmm.
For most of 2025, prices were stubbornly steady year over year. They were absorbing the rate shock without a major correction.
Right.
But that 5.4% drop we saw in November tells us that buyer tolerance finally broke. It means all that accumulated pressure from high rates, from homes sitting on the market longer, it finally cracked the foundation of price stability.
So for a seller listening to this right now, what's the takeaway from that 5.4% number?
It demands a complete paradigm shift in your strategy. You absolutely cannot rely on comparable sales, the comps, from even 3 or 4 months ago. It's just not accurate anymore.
If you do, you're setting yourself up for failure.
You're setting yourself up to become stale inventory. Your home sits for 70, 80, 90 days, and then you're forced to make a much deeper, more painful price cut than if you had just priced it right from day one. That 5.4% dip is the market giving sellers a very direct, non-negotiable message. Adjust your expectations and do it now.
Okay, let's stick with that cooling macro trend for a minute. Let's look at the entire North Texas region, November 2025 versus the year before. The drop in just the number of transactions is, well, it's staggering.
It's the most dramatic figure because it measures actual commitment. The regional slowdown is quantified by an 11.1% drop in closed sales.
So in real numbers, what does that look like?
We went from 8,630 homes closing in November of 24 down to just 7,673 this past November. That's nearly 1,000 fewer transactions across the region in a single month.
1,000 fewer families moving? That is a serious slowdown. What does an 11% drop like that tell you about the people who are still in the market?
It tells you that only the most motivated people are left. For sellers, they're often facing huge life changes, a job move, divorce, downsizing, an estate sale. They have to move.
And the buyers?
The buyers are either cash buyers who are insulated from the rates, or they're people who have waited so long that their need is urgent, and they've already gone through the pain of qualifying for this high-rate environment.
So the casual looker, the opportunistic buyer...
They're completely gone. Sidelined, what's left are the high-stakes transactions.
And that drop in volume goes hand in hand with the price drop. Regionally, the median price is down 5.4% to $352,900. But you pointed out a really critical piece of context here, the year-to-date number.
Yes, and this is where the nuance is just everything. So while that November monthly number shows this sharp 5.4% correction, the year-to-date MSP, that's for the whole 11 months of 2025, is only down a tiny 0.8%.
Wait, that feels contradictory. How can the market be stable for 10 months and then just suddenly fall off a cliff in month 11?
It shows that for most of the year, the market was basically running on fumes. Latent demand, stable jobs, and just a psychological expectation that prices would stay high. Sellers were successfully pushing back against the rate hikes.
But November was the breaking point.
November was the inflection point. All that pressure from high rates, which eats away at buying power month after month, combined with this slow buildup of inventory. It finally forced prices down sharply. This concentrated recent drop is the signal that the structural change is here to stay.
And the most painful part of this for sellers has to be the time. The velocity is just collapsing, and we measure that in days on market.
The DOM is surging. Regionally, the average time it takes to sell a house, so from listing to an accepted offer, that's up 16.7% to 70 days.
70 days. So the average seller should plan on their house sitting for over 2 months.
Over 2 months. And that's a crucial metric because it tells us the buyer is no longer operating under scarcity pressure. They're not panicked. They can tour multiple homes, take their time with inspections, really deliberate on their options.
And when we say 70 days, that's not just a number on a spreadsheet. That has a massive psychological impact on the seller, doesn't it?
Oh, absolutely. I mean, think about the seller who listed their home based on their neighbor's house that sold in 15 days last year. At day 30, they're getting annoyed. At day 45, they're starting to worry about carrying 2 mortgages or, coordinating their next move.
And by day 70?
By day 70, they're exhausted, they're financially vulnerable, they're desperate to avoid hitting that 90-day mark where a home is officially considered stale. And that emotional fatigue, that desperation, it translates directly into more leverage for the buyer on day 71.
70 days. It's just a clear sign we are so far from the sold-in-a-weekend frenzy of the pandemic.
It's a different world.
So let's talk about the supply side. We mentioned the lock-in effect should be limiting supply, but the data shows inventory is actually still growing.
It is, which proves that those external pressures, life events, job transfers, are still forcing some homes onto the market. The regional inventory of homes for sale grew by 3.5% year over year. That brings us to 46,879 total units.
And that modest growth has a direct impact on the month's supply of inventory, the MSI.
A direct impact.
So MSI is one of those key metrics for market health. Remind us what the regional MSI of 4.8 months tells us about the market balance.
The MSI is basically a measure of liquidity. It calculates how long it would take to sell every single home on the market right now, assuming not a single new home was listed, given the current pace of sales.
Okay.
And, conventionally, economists consider a balanced market where neither the buyer nor the seller really has an edge to be somewhere between 5 and 6 months of supply.
So at 4.8 months, we are technically still in a seller's market, but just barely.
Precisely. We are one slow month or one small jump in new listings away from tipping into a true balanced market. The key insight here isn't the number 4.8 itself, it's the movement. The MSI is up 2.1%. That confirms supply is growing faster than demand, and it's pushing us very quickly towards equilibrium.
All right, let's pivot to maybe the silver lining in all this data, especially for first-time buyers or people who are renting right now. The Housing Affordability Index, the HAI, is actually signaling a major shift toward accessibility.
This is where it gets really interesting for anyone who's not trying to time the peak of the market. The Housing Affordability Index jumped from 87 in November 2024 to 97 in November 2025. That is a significant 11.5% increase in affordability in just 1 year.
An HAI of 97. What does that mean in plain English, and why did it jump so much? Was it because everyone got a huge raise?
Not at all. The HAI compares the median household income in North Texas to the income you'd need to qualify for a loan on the median-priced home at current interest rates. A reading of 100 means the median income is exactly what you need. So last year's 87 meant the market was severely out of reach for the typical earner.
And the jump to 97.
That jump is driven almost entirely by that rapid price correction we just talked about.
So that 5.4% drop in the median sales price, what is that, $20,000 or so? That's enough to move the needle 11.5% on affordability.
It is, because that price drop immediately lowered the income you need to qualify. And that effect was powerful enough to overwhelm the persistent drag from high interest rates. So even though rates are still painful, the asset price itself is softened enough to bring the goalpost for ownership much, much closer to the median earner.
That 11.5% jump is a huge aha moment. It means there's a whole group of buyers who were totally shut out 12 months ago who now have a real fighting chance. The market is correcting to meet their financial reality.
Correct. The market is becoming more accessible for that key demographic. And when you couple that increasing affordability with the higher days on market, you get a very favorable environment for patient, financially prepared buyers who don't have to win a crazy bidding war.
Okay, so that's the macro picture. Let's shift our focus now and zoom into a very specific high-growth area, Denton County. Denton has always been this major growth engine for North Texas, right? Attracting companies, new residents.
It has.
So how does a market like that, a market known for intense desirability, how does it handle this kind of macroeconomic cooling?
Denton County is a prime case study because it's a paradox. It is still a place where people want to be, no question. And yet its sellers are suffering a sharper price correction than the region as a whole. The story here is intense competition, but that competition has shifted. It's now among sellers, not among buyers.
Which brings us to what you called the new listings paradox. Regionally, listings were down 4%, people were holding back. But in Denton, new listings were actually up 2.4%. Why were Denton sellers so confident?
Well, it's probably a few factors. First, Denton has a lot of new construction that's closing out, and that adds fresh competitive inventory to the market. Second, Denton's popularity means you have a higher churn rate. People relocating for jobs, moving up within the county.
So they're not held back by fear, they're driven by necessity.
Exactly. They're actively engaging with the market, even with all the uncertainty, because they have to.
So if more homes are hitting the market in Denton, what was it, 1,250 homes listed in November, that has to translate into a massive spike in inventory.
Absolutely. And this is the data point that explains the pain in Denton. The inventory of homes for sale in Denton County shot up 15.1% year over year. It's now near 5,000 units.
15%. That's more than 4 times the regional inventory growth.
It is. It's a huge shift in the local supply, and it's the direct cause of the price correction. All of a sudden, buyers have a massive selection.
And when buyers have that much choice, the cost of competition for sellers just skyrockets. What was the damage to the median sales price?
Denton County saw a much sharper correction than the regional average. While North Texas as a whole dropped 5.4%, Denton's median sales price fell a staggering 9.2%. It went from $462,500 down to $420,000.
Wow.
It just confirms that the markets that saw the steepest run-up in prices during the boom, like Denton, are now seeing the steepest correction when rates choke off demand.
It's important to point out, though, that Denton is still a pretty premium market. The average sales price is even higher. It's over $500,000 at $511,776.
It is. Which shows the market is diverse. You still have high-end properties pulling that average up. But the median transaction, that typical suburban sale, that's where you're seeing some serious depreciation.
So let's look at the market balance there. How does Denton's month supply of inventory compare to the regional 4.8 months?
Denton's MSI jumped 13.9% to 4.1 months. So while it's technically still a tighter market than the region, that 4.1 months is much closer to a balanced market than it was a year ago. A nearly 14% jump in supply relative to sales. That's a rapid move toward equilibrium. Denton is renormalizing very, very quickly.
So more inventory, more supply, falling prices. That is a tough reality for a seller. How does that difficulty show up in the time it takes to sell and the final negotiated price?
The difficulty is measured in time and in concessions. Denton's average days on market increased 13.6% to 67 days.
67 days, that's almost 10 full weeks for a transaction.
It is. And sellers who are expecting a quick sale are immediately hit with the reality of that pace.
And when an offer finally comes in after 67 days, how much leverage do they really have left? Let's talk about that crucial sold-to-list price ratio.
This is maybe the most painful metric for a Denton seller. The ratio is sitting around 93.0%. That's down from nearly 95% the year before. So, to put it in real terms, if you list your home in Denton for $500,000, you are, on average, walking away with $465,000, a $35,000 discount.
And that 7% difference, that's not always just a simple price cut, is it? What kind of concessions make up that 7% buffer that buyers are now winning?
That's a great question because buyers are being really sophisticated here. They aren't just lowballing the price. They're using that 7% buffer for other really critical things.
Like what?
The most common one right now is the interest rate buy down. Buyers know rates are high, so they're asking the seller to contribute, say, 2 or 3% toward their closing costs. The buyer then uses that money to buy down their interest rate for the first year or two of the loan.
Which is much more attractive to a cash-strapped buyer than just a flat price cut.
Far more attractive. And sellers are accepting it because it gets the deal done.
Now, before we broaden the scope, you mentioned a really fascinating local metric, the hotness ratio. How are experienced agents using this to see past the big county-wide slowdown?
The hotness ratio is a critical localized tool. It helps you pinpoint these little micro markets of activity. It basically measures the percentage of homes that went under contract very quickly, say under 10 or 14 days, versus the total number of listings in that area.
So it's telling you what percentage of the inventory is still moving fast, basically defying that 67-day average.
Exactly. The higher the ratio, the hotter that local market is. For instance, the data showed that while Denton City proper sits at 23.9%, Louisville, which is a major city within the county, has a higher ratio of 27.7%.
And what is it, a 3.8 percentage point difference? What does that tell an agent?
It tells them that Louisville has a measurable, distinct competitive edge. So if you're listing a home in Louisville, you can tell your client that there is demonstrably stronger localized momentum and faster buyer migration than in Denton City proper. It's an immediate diagnostic tool that shows demand isn't uniform and that Louisville's submarket is just a little more desirable right now.
Okay, so if the regional numbers show cooling and Denton shows a sharp correction, the full net trust data seems to paint this picture of a really fragmented market.
It's not a single entity at all. It's a collection of hyper-local environments.
Let's transition to that. Let's build a framework of comparison, looking at the wider region, focusing first on the major metro counties and then maybe some of the extreme outliers.
This divergence is really the defining characteristic of this new post-frenzy market. When liquidity dries up like this, stability just cracks, and you see these wildly different outcomes, even in neighboring counties.
All right, so let's start with the three giants, Tarrant, Dallas, and Collin. How did they handle the pressure compared to Denton's 9.2% price drop?
We can start with Tarrant County, anchored by Fort Worth. That market saw a big slowdown in sales volume, but it kept this remarkable stability in its supply balance. Closed sales were down 14.3%, a really severe choke on transactions.
Okay.
Yet, new listings were only down 0.6%.
So Tarrant sellers were listing, but the buyers weren't closing. What protected its prices from a bigger drop?
Tarrant's median sales price only decreased a modest 4.5% to $335,000. That's less severe than the regional average and way less than Denton. The protection comes from its affordability, really. Tarrant offers a lower price point and often better value than Dallas or Collin, so it's a destination for buyers who are budget conscious but still need that major metro environment.
And the supply-demand balance backs that up, right?
Crucially, yes. Tarrant's month supply of inventory is holding steady at 3.6 months, 0% change year over year. That 3.6 months is the tightest of all the major counties. It means that while the number of deals is down because of rates, the underlying supply-demand pressure is still strong enough to prevent a major price collapse like we saw in Denton.
Okay, now let's move east to Dallas County. Transaction activity there slowed even more than in Tarrant.
Dallas County saw one of the biggest drops in closed sales among the majors, down 17.9%, a serious pullback from buyers. But Dallas County showed the most price resilience of any of them. Its median sales price drop was minimal, just 1.8% to $353,500.
That is astonishing, to be down less than 2% compared to Denton's 9% drop. Why is Dallas County holding its value so much better?
There are probably two big factors. First, Dallas County, especially areas closer to the urban core, has a higher proportion of luxury or unique housing stock that's just less sensitive to mortgage rates. You're attracting cash buyers or high net worth individuals.
And the second factor?
Second, the price point of $353,500, while a bit higher than Tarrant, is still relatively accessible and benefits from proximity to all the major corporate centers, so the market is segmenting. The middle tier, like Denton, is getting squeezed, but the luxury and the most affordable urban segments are proving to be more resilient.
But that resilience came at a cost. The velocity slowed way down.
It did. The market is basically trading speed for price stability. Dallas County's days on market increased 23.4%, hitting 58 days. So buyers are taking their time, they're prolonging the sales cycle, even if the final price cut ends up being minimal.
And finally, Collin County, historically the high-end growth engine north of Dallas. How did that premium market fare?
Collin County experienced a significant correction. It really confirms that this slowdown is hitting the higher price tiers quite hard. It still have the highest median sales price among the majors at $435,700, but it saw a sharp drop in that MSP of 8.3%. That's a huge adjustment at the top end of the market.
What about their supply dynamics?
Inventory shot up. It increased sharply, up 19.6% year over year. Think about that. Almost 20% more homes for sale.
Wow.
But despite that massive influx, Collins MSI is still relatively low at 4.1 months, the same as Denton, which suggests that while expensive homes are now taking price cuts and sitting longer, the underlying demand from high-earning professionals is still large enough to absorb that new inventory pretty quickly.
So the major metros show fragmentation, but the wider Netris region shows, well, outright chaos. When transaction volumes drop this low, volatility just spikes, leading to these unbelievable monthly price shifts in the smaller micromarkets.
We have to preface this by saying these dramatic shifts are almost always because of a very small sample size. A handful of unique sales that just skew the median. But the data really illustrates the extreme risk in these less liquid areas.
So let's start with the extreme price increases. What stands out there?
Coleman County is the poster child for volatility. Its median sales price soared 170%, going from $60,000 to $162,000 year over year in November. On paper, that looks like an incredible investment opportunity.
But the data tells another story, doesn't it?
It does. At the same time, Coleman County's days on market exploded from 20 days to 138 days. So that 170% price jump isn't from a healthy, surging market. It's likely one or two high-value, unique ranch properties that closed and skewed a historically low baseline. The fact that it now takes over 4 months to sell anything there tells you this market is not functioning efficiently at all.
Okay, let's look at the price pain. Where are the sharpest corrections in these outer ring counties?
This is where we see sellers absorbing just immediate, brutal losses. Franklin County saw its MSP drop a shocking 78.0%. It fell from over $635,000 down to just under $140,000.
A 78% correction. That's devastating.
It is, and it tells you one of a few things is happening. Either an extremely high-value property sold last year, skewing in the baseline, or you have a large influx of distress sales, forced liquidations. Similarly, Harrison County was down 41.8%, Limestone County down 39.7%.
Right.
It's a crucial lesson. In low liquidity markets, price stability is an illusion.
What about transaction velocity? Were there any places where closed sales actually grew?
In some of these very low volume counties, yes, we saw massive percentage spikes, likely from just a few successful deals closing, or maybe an investor group coming in. Callahan County saw closed sales jump 150%. Rains County also saw a 150% spike.
Okay.
Again, small volumes, but it suggests that if you hit the right price point, demand can materialize quickly.
And finally, the extreme contraction, the markets where everything just stopped.
This is maybe the most concerning signal of all. Nolan County and Stevens County both saw their closed sales volume drop 100% in November. They went from a handful of sales to zero. Zero sales. Stonewall County also dropped to zero.
Zero closed sales. What does that mean for a community?
It means the entire local residential market just froze solid. Lenders are likely exercising extreme caution, or potential buyers just can't qualify. It reinforces this idea that the North Texas market is fundamentally fragmented, and these low liquidity areas are extremely vulnerable to a total shutdown during an economic tightening.
Okay, so now let's synthesize all of this. Let's focus on the critical metrics that really determine success in this new, slower environment. That's negotiation, pace, and long-term trends. Let's start by revisiting the percent of original list price received.
This metric regionally is now at 93.1%. That's down 1.3% year over year. And it confirms that the buyer has recovered a substantial amount of leverage. On average, across all of North Texas, sellers are accepting a nearly 7% concession off their initial asking price.
So that 7% average is the buyer's new negotiation room.
Yeah.
For sellers, how do they avoid going way past that average and being forced into, say, a 10 or 15% concession?
The only way to stay close to that 93% average is through highly accurate initial pricing. If a seller overprices based on emotion or outdated comps, their home is going to hit that 70-day regional average or worse.
And at that point, the buyer smells desperation and the leverage flips completely, forcing the seller way below that 93% mark.
So successful sellers are pricing aggressively from the start. They are. They're recognizing the new environment, listing at or even slightly below the true current market value. And they're aiming for a quick, efficient sale that minimizes that opportunity cost of time.
Let's look at the extremes in negotiation. You mentioned Harrison County earlier with that shocking price drop. How did that translate into leverage?
It translated into a bloodbath for seller control. Harrison County had the biggest drop in list price received, down a massive 25.3% year over year. They settled at 76.5%.
So a seller in Harrison County listing at $200,000 is accepting $153,000.
An extreme loss of leverage. That's almost certainly indicative of distress sales or property that was just grossly overpriced to begin with.
And on the other end,
Conversely, Somerville County managed to maintain a high ratio at 95.7%. This suggests that while their prices may have softened a bit, the buyers who are in that market are willing to pay very close to asking, demonstrating some real localized demand.
that nuanced data really shows how much the local environment matters more than any regional average. Now, let's talk about the velocity shift, the time factor in a more long-term context.
The slowdown in pace is absolutely systemic. It is not just seasonal. If we look at the year-to-date regional days on market, comparing the entire 2025 period to 2024, the DOM is up 18.5%. It went from 54 days to 64 days.
That 18.5% increase over a whole year shows that the competitive fire has been structurally eroding all year long.
It does. It means buyers can afford to wait 64 days year-round, knowing that the pressure is off. And then you have the extremes. The fastest market in November was Harrison County, ironically, at just 15 days DOM. But they're only selling that fast by taking those huge price cuts.
And the slowest.
The slowest markets are just frozen. Shackelford County is crawling at 156 days. Delta County at 155 days. That 15-day versus 156-day disparity is the definition of a fragmented market.
Let's touch on inventory depth again. Regionally, we're at 4.8 months supply, approaching balance. But where are the true buyers markets forming? Where is supply just overwhelming demand?
We're finding deep buyers markets in counties that have just completely lost liquidity. We're talking 6 or more months of inventory extreme saturation. These are places where sellers are truly desperate. Montague County is stretched to 12.6 months of supply. Limestone County is at 11.8 months. And Stevens County is sitting on a massive 13.5 months of inventory.
Over a year's worth of inventory on the market. What kind of leverage does a cash buyer have in a place like Stevens County?
Overwhelming leverage. If you are a financially qualified buyer in a market like that, you are setting the terms. The seller has been carrying that home for months with zero sales activity. In those areas, buyers can demand massive concessions, often well below that 93.1% regional average.
Finally, let's put this all together for the investor or the first-time buyer. High rates are the pressure, yes, but price drops, increased DOM, and that improving affordability index. That's the opportunity.
The conditions are shifting decisively in favor of the buyer who has their capital ready. That 11.5% rise in the HAI means the hurdle to homeownership is genuinely lower than it was last year. For investors, the price softening, the asset itself is cheaper, combined with that 7% negotiation buffer, means they can acquire assets at a discount.
So the overall environment is one where patience and aggressive negotiation are rewarded, whether you're a first-time buyer leveraging that affordability shift or an investor hunting for discounts.
Absolutely. The buyer no longer has to compromise on price, on terms, or on the inspection. They are regaining control of the transaction, and that is the most significant consequence of this November 2025 data shift.
This has been an incredibly detailed deep dive into a North Texas market that's really defined by structural tension. Let's give a final summary of the market truth for November 2025.
The market is unequivocally cooling. It's defined by slowing transaction volume, down 11.1%, and price softening, with the median price down 5.4%. But that macro trend is really just a thin veneer over extreme local divergence. Denton County shows us that even growth engines can face massive corrections when high listing activity floods a rate-choked market.
And the power has shifted.
Completely. Seller power is fading, replaced by decisive buyer negotiation leverage, which is quantified by that 93.1% average price received.
Okay, so here's the final provocative thought for you, the learner, to take away from all this complex data. If you are a buyer, a seller, or an investor, what is the single most crucial metric you have to focus on in this new environment?
It is not the median sales price, it is the days on market, the DOM. The true cost for a seller today is defined by time, not just by price. In the competitive frenzy, everyone focused on getting the highest premium. But in this high inventory, slower market where the regional DOM is 70 days, the true cost for a seller is the opportunity cost, the mental fatigue, and the risk of having a massive asset tied up for over 2 months.
So this shift in the priority of time is what defines strategy now.
It defines everything. Sellers must master accurate pricing to reduce their DOM, and buyers must master patience, using that extended DOM as their primary source of leverage.
Excellent insight. Time is the new scarcity. That's a wrap on our Don't Dive into the North Texas real estate shift. Thank you for cutting through the noise with us.
Always a pleasure.
Farewell.